All right, today we're going to deconstruct a giant. But this isn't just a story about Berkshire Hathaway. It's about learning a new way to think, a framework you can use to analyze any company. Our goal is to go past the what and get to the how to think like a real strategist. So let's dive in.
Let's start with a number. $318 billion. That's Berkshire Hathaway's cash pile. I mean, that's bigger than the entire economy of a lot of countries. But look, this isn't just money sitting in a bank account. It's a strategic weapon. So the real question is, how on earth does a company get that much firepower, and what does it tell us about how the whole thing is wired?
So here's how we're going to break it all down. First, we'll look at the accidental engine to see what business they're really in. Then we'll dissect that machine to see how it works. After that, we'll examine their unbeatable moat. And finally, we'll pull out the key lessons and strategy you can actually use.
So, part one, what is this company really about? Because if you think it's just about railroads or insurance or See's candies, well, you're only seeing what's on the surface. The truth is, at its very core, Berkshire Hathaway started as a failing textile mill and, almost by accident, became one of the greatest capital-moving machines the world has ever seen.
Here's the fundamental problem that Berkshire solves. See, in most big companies, the profitable parts are forced to prop up the divisions that are failing. It's just how budgets work. Berkshire completely shatters that model. It tells every single dollar of profit, hey, you're a free agent. Go find the best possible job you can. I don't care what industry it's in.
And you know, the company's own origin story is the perfect example of this. The original Berkshire was what you'd call a classic value trap. Think of it like a business that's constantly burning through cash just to tread water in a sinking industry. The key insight, the genius move, wasn't to try and fix the dying textile business, it was to stop feeding it money. They pulled the cash out and put it to work somewhere else entirely.
That one big idea led to three really distinct eras of growth. First, you had the cigar butt phase, where they'd buy super cheap businesses that had, maybe one last puff of profit left in them. Then, they evolved and started buying wonderful businesses at fair prices, companies with real, durable brands. And finally, as the money piled up, they entered the current phase, becoming a capital sponge, buying massive businesses like railroads just to have a place to put all that cash to work.
Okay, so that's the history. That evolution created the absolute machine we see today. But how does it actually work? How does it make money? Well, you can think of it as an ecosystem with two engines that are perfectly in sync. One that sucks in cash and another one that intelligently deploys it.
And to understand that first engine, the one that brings in the cash, you have to be able to answer this question. It sounds completely impossible, right? But this little paradox is the secret to Berkshire's entire financial structure.
And the answer is a two-word phrase: insurance float. Think about it. When you pay your Geico premium, you're giving them your money up front. They get to hold on to it and invest it for themselves, and they only have to pay it back to you later if you get in an accident. That pool of money they're holding is the float. And for Berkshire, that float is a staggering $171 billion. That's engine number one.
Now, here's where the real magic happens. If their insurance companies, like Geico, are run well, the premiums they collect are actually more than the claims they pay out. That's called an underwriting profit. And if that happens, it means the cost of borrowing that $171 billion is actually less than zero. They are literally getting paid to borrow money. It's like economic alchemy.
So, where does all that cash end up? Well, this chart tells you pretty much everything you need to know about their priorities. Just look at that huge slice going to capital expenditures. That's things like railroad tracks and power plants. And then look at that tiny, tiny sliver for headquarters overhead. This shows you a very clear, very deliberate trade-off. They'd rather spend money on hard, durable assets than on corporate bureaucracy.
Now, this is a tricky question. Who are the real customers of this whole machine? Well, yeah, there are the day-to-day customers like you and me buying a Geico policy. But the customer that is most important to their strategy is a very specific person, the founder of a big, private, family-owned business who's looking to sell. What Berkshire offers them isn't just money. It's a permanent home for the company they built.
And that is exactly why they can win deals without always offering the highest price. See, a private equity firm might offer more money, but that comes with a 5-year plan to slash costs and then sell the company for parts. Berkshire offers trust, permanence, autonomy. A founder who sells to them is trading a little bit of cash for the peace of mind that their life's work is safe.
So this unique offer to founders is a huge part of their competitive advantage, what you'd call their moat. Let's dig into that a little more. What makes this whole structure so tough to compete with? Why is it so hard to copy what they do?
It really all boils down to one single core advantage. The deepest, widest part of their moat is financial. It all goes back to having a negative cost of capital. I mean, think about it. While a competitor is going to a bank and paying 7% interest to fund a deal, Berkshire is using its insurance float, which, again, it's often getting paid to hold. That's a structural advantage that is almost impossible for anyone else to replicate.
And that one financial advantage is what makes all the other ones possible. It's like a pyramid. At the very bottom, the foundation, is that negative cost of capital. That allows them to build the next level, a fortress-like balance sheet. And that financial strength is what supports the very top of the pyramid, their brand and reputation as a trustworthy, permanent owner. Each layer supports the one above it.
But let's be clear, they are not operating in a vacuum. The interesting thing about their competitors, though, is that there isn't just one. It's more like they're fighting a war on multiple fronts. When it comes to buying companies, they're up against private equity giants. In the railroad business, they're head-to-head with Union Pacific. And in insurance, they're in a dogfight with tech-savvy companies like Progressive. And here's a really critical insight for any strategist. Berkshire doesn't win everywhere. They absolutely have weaknesses. Their railroad, for example, is less efficient than Union Pacific. Their insurance arm was slower to adopt technology than Progressive. And in a straight-up bidding war for a company, they almost always lose to private equity. The big takeaway is that Berkshire only wins when it can play a different game than everyone else. Okay, this brings us to our final section, the lessons. We've seen how the machine is built, we've seen why it's so hard to beat. Now let's look at how it learns from its own mistakes and what real, transferable lessons we can all take away from this.
First up, innovation. You might find this surprising, but there is no big, fancy, central R&D department at Berkshire. The whole philosophy is decentralized. That means each individual business is responsible for its own innovation. So you get this mix where some of their companies are aggressive innovators and others are happy to be conservative, fast followers. It's a trade-off. They give up synergy for autonomy.
But you know, having a great system doesn't make you immune to mistakes. And to really understand how Berkshire learns, you have to dissect its biggest failures. This quote right here, it's a lesson learned from the Dexter shoe deal back in 1993, a mistake that Warren Buffett himself has called his absolute worst.
And Dexter was not the only one. We are talking about massive billion-dollar mistakes here. These weren't just math errors. They were failures to understand the fundamental story of the business. With Precision Cast Parts, they bought a cyclical company at the very top of its cycle. With Kraft Heinz, they learned the hard way that you can't just cut costs forever without destroying a brand. You have to study the losses just as hard as the wins.
But, and this is the most crucial part, they learn, they adapt. For example, their investment in IBM was a failure because they just fundamentally misunderstood the business. But they took that lesson and they applied it years later to Apple. They realized Apple wasn't just a tech company, it was a consumer products company with an unbreakable hold on its customers. That one mental shift, that reframing, led to one of the most profitable investments in modern history. So, let's wrap it all up. What is the Berkshire way of thinking? Well, here it is. Why did they succeed? Not because of some magic stock-picking formula, but because they built a system with incredible structural advantages, like a lower cost of capital and a longer time horizon. What's their biggest risk today? Honestly, it's just their own enormous size, which makes high growth almost impossible. And what's the thinking pattern you can reuse? It's this. Don't just try to play the game better than everyone else. Build a system that lets you play a completely different game.